Good day, class. Again, let let us continue with the next topic for this entrepreneurship and tourism and hospitality. So we have chapter 8, creating a successful financial plan. Okay, the last time we've discussed about the marketing plan. So now let's proceed to the financial plan. So at the end of this chapter, it is important class to interpret, of course, the financial statement. So this financial statement can help out on how we will project the different expenditures of this entrepreneur, wherein all the statement is presented including the cash flow. So we have to create also and interpret the cash flows and determine the break even points, evaluate the investment in a working capital in a long term asset, and of course to demonstrate proficiency in financial ratio analysis. So in every business class, it is important for a business to be funded accordingly, and this fund is very helpful. And for this plan to execute properly, it is important that we have this asset. So putting up a business is not only for physical and mentally um, prepared. We need to be mentally and physically prepared, but of course we need to be financially also equipped. So a business, whether it is micro, small, medium, or large, should be backed up, of course, with a financial program. So that's number one. That is number one um, important, no? Especially in doing a business, you should have, of course, your backup money, and you should have your uh, financial plan as well in order for you to project the right calculation of your um, intended business, no? So we have the sources of finance. Of course, your business should be funded with different kinds of resources, and of course it can be a personal saving account. um, so if you have a personal saving, you can use that for your business. You have also if you have also owned properties, mortgage, or individual equipment and money, of course, raised from your family and friends, and these are called internal sources that are injected into your business. You can also use the bank as your resources, and rent to own or leasing, no? So these are the sources of fund. So it is important for an owner of the business to find out any financial um capability. So this financial capability is important, because if it is lacking, then there will be a major cause of most business failures. So you have to check, you have to identify all your asset, which is considered as important elements, especially in making the business profitable. Okay, we have also the equity ownership, wherein it comes from the investment of owners and returned earnings like profit. And we have also the net income, which depends on the number of sales, the cost of goods sold, operating expenses, interest expense, and taxes. So you have to assess first what kind of funds you may have in order to start your business. Okay, by managing also your finance is also one way that can help you into um, success onto your success, especially if you're talking about the backup, no, the backup for this kind of business. So we have also the basic financial statements, wherein statements serve as a form of financial reports about the performance and resource of a firm. So these financial statements serve as a tool to determine a financial requirements and assess the implication of a business plan. So another thing is that there's an income statement now that is considered as a form of financial statement that summarize all the revenues and expenses over a given period. So these are the different kinds of statement wherein it must be addressed properly for the reports and will serve as a tool especially for the requirement that is needed, no. So again, financial statement, you have to um, you have to check everything, especially for the state different kinds of income statement in a given time. So we have also the firm's profit or income, which derive from the sales or revenue generated minus the expenses incurred during the period. So the profit would come from your revenue. So if you're gonna less the expenses during the given period, that is considered as your net profit. So expenses include also the cost of product or services and operating expense, such as by doing your marketing, by means of selling, and even administrative expenses and depreciation. So these costs also like financing costs, like interest paid and taxes is also must be also included on your financial statement. So earnings before interest and taxes, it's called EBIT, is also known as the operating income. So we have to check the operating income. This can be derived if we deduct the expenses and depreciation and amortization from the sales. Okay, so another thing is the net income. It is the amount distributed, no, to the owners or put back and reinvested in the company. So income can come from the revenue when we remove all the expenses, and that would be the net income. So remember that when you earn something, you have to pay also something. So there's an interest, there's taxes. So you have to less that one in order to have the net income. And also, you have to deduct the operating costs or the expenses. Another term for this financial management is balance sheet. So this kind of financial statement provides a picture of a firm financial situation at a point. So this balance sheet report that shows a firm's asset, liabilities, and owner's equity. So, in a business plan, we have to seek approval for loans, investment, or grant for the organization, include a balance sheet to show the firm's financial stability. So, this balance sheet serve as the statement that provides, of course, the situation of our finance. Now, whether the asset, liabilities, and the equity um, is okay, and that's enough to consolidate everything and check whether you are uh you have the earnings or not. So the balance sheet um basically help out the business to provide a financial situation. Okay, so equity is also called the net worth of the business. So if we if we're going to um, define, no, the owner's equity, it is considered the money that the owners invest in the business. Okay, that's his equity. So retained earnings are the profits minus the dividends withdrawn from the business. So we call the business the net worth of the business as an equity. So once we put the money into our business, it is considered as the equity. So we have the cash management. So if we talk about cash management, it is actually a financial report shows the movement of money as the business is conducted. So meaning financial report shows that all the assets and all the statement, okay, from the assets, and of course there are liabilities. Any report from the finance shows that how this money is invested, or how is the process of the money, no? So we have to look into the cash that is reflected as income when it is received and shown as the expense, as an expense now when it is paid. So cash is reflected as income here. So net working capital is the money invested in a current asset minus account payable and accruals. So it is important to have the net working capital. Okay, so once you invest in a current asset minus accounts payable, that is called as the net working capital. Okay. So accounts payable, these are the things that we need to pay as fixed expenses. No? So once we are already using the money, okay, the invested money, especially in the current assets, no, it is called already as the net working capital. So we have also the cash budget. So financing activities are the fastest sources of increasing cash flow in the business. So we have also what we call the petty cash. No, if we talk petty cash, we allotted a certain portion of our cash, no, into different kinds of expenses like daily expense. So we can put that in the petty cash and using the voucher. So financing activities are the fastest, no, for the cash flow in the business. A financially a sound and healthy venture can easily attract by the investor. Okay, so businesses are scrutinized based on the profitability of the business asset, settlement of debts, and the rate of return on investment by the owners. So, as you can see, no, if you are going to make a loan from the bank, usually they are checking whether you are in good terms with the other bank. If you have they are checking whether you have the previous loan, if you settle your debt, if you um if you have good standing, no, with regards of your finances. So it's important to see the budget of a company, because sometimes that's how the other investors not check um they are persuaded to invest once they see the financial status of the company is doing well. Okay, so it is important the ratio analysis and interpretation of ratios. We have the business plans that are evaluated for financial feasibility through the financial statement and financial ratios. So these ratios are used to facilitate comparison between figures and help standardize the number. So meaning class, we have the different matrix, no, wherein business plans are evaluated. So they call it as the feasibility through the financial statement and ratios. So ratios analysis is used to determine the different characteristic of the business, such as liquidation, solvency, profitability, and others. So if we talk about ratio analysis class, it is a sample computation of all the asset that is coming, all the expenses, and of course the revenue that comes from the different purchase. It's a part of the computation for the earnings. So it's important to interpret your ratios. So we have the profitability ratio. This kind of ratio reflects the company profit in relation to its asset. So it measures the ability of business to earn profit in relation to its expense. So we have ratios in category are used to measure if the company is profitable when compared to previous period or compared against competitors. So this kind of profitability ratio is that you may able to see whether your company is earning have an earnings in the previous periods, or even comparing it to the competitors. So that's why it's important. So the market value ratios help predict the possible amount of earners in the investment. So, like for example, if you have the projections of sales, we arrive for a market value ratios. So, in this case, we can able to predict no the possible earnings. So, like earnings per share equals, so kung ano yung earnings natin class, or earnings per share, this the formula is a net income. Okay, if we talk about net income, we already deducted all the expenses. So that is considered net income. You have to divide it to the total number of the outstanding share, and that is called the earnings per share. So if we talk about dividend yield, the total dividend payments paid per year divided by the market price. Okay, we have also the market value per share, wherein total market value of the shares divided by the total number of outstanding shares. So this kind of ratio analysis class, it's basically on the investment. No? So if someone invests from your company, it's considered as the market share. So we tend to get the market value per share by uh, doing the total market value of the shares, the total market value of the shares, you have to divide it the total number of standing or outstanding share. So we have also the break-even analysis wherein once we calculate everything and we see that there's a balance between your earnings and your expenses, no? So that means that you have this kind of break even analysis to determine the acceptability of a set price for both the business and the customer, to know the volume or level at which the product will generate enough revenue for the company to become profitable. This stage is also known as the break even point. It is where the total sales is equal to the total cost. So we have also the pricing strategies and tactics that you will need to do is to make sure that you have the proper calculation for your um, product, no, especially for the pricing. So you have to strategize to ensure that you are correct with regards of the um, pricing. So you have to do your pricing to ensure that the firm will continue to exist, gain patronage, and become a market leader for a long period. So the objective of the pricing is to earn profit. So the price is the sum or the amount of money required by a seller in exchange, of course, with their goods and services. Okay, so the structure in setting a price, we have the cost-based pricing, which consider the cost of the goods sold, expenses incurred in selling, and the overhead costs. We have also the competition-based pricing. Consider the price that is set no by the other market. Ito yung mga price not the same. You make it align with the other competitors. While the other one, the value-based pricing, it is focused actually on the perceived value received by the customer when they purchase or avail the product. If the price is worth it, no. So um, this is the three kind of structures in setting a price. So if we talk about cost base, so it is considered as the pricing on how much it costs, and you just add up no the um, markup for your price, no. So pricing concept for service firms and food retailers. So we have the synchro pricing, we have the market segment pricing, and complementary pricing. So businesses set the price of their goods and services based on how they read the willingness of the customer to pay. So if it is by capitalizing on customer sensitivity to price, they call it pricing. So, but if it is based on the target market, so market segment pricing, if it is closely interrelated products, it is called the complementary pricing. So, okay. So, there are times most of the owners use the synchro pricing, wherein they capitalize on the sensitivity of the customer to the price. So they derive the price to what is on the market, and it depends. No, it depends on the set goods and services. No, and of course the buying capacity depends on the buying capacity of the guest. Okay, That would be all for the financial management. So in to summarize the financial management class, it is important for us to know the different strategies on how to project the statement, no, of your company, because in this way we can able to predict, we can able to sum up all the things that we need and to less all the expenses. And once we able to do that, it would be easier for us to allocate the resources, especially the earnings. So it is important to also encourage investor by your good standing on your finance on your financing also will be considered to have a good market share. So again, thank you so much and have a nice day, class.